All right, let's dive right in. Today, we're putting two heavyweights of the fixed income world head-to-head, debt funds versus corporate bonds. If you're looking for some stability beyond the stock market, you've definitely heard these names a lot. But here's the thing, the right choice for you in 2025 might not be what you think. So let's break it all down.
You know, for a lot of people, these two can seem pretty similar. I mean, they both offer a lot more stability than stacks, and they're both a big part of any conservative portfolio. But trust me, underneath the surface, they are totally different animals, and really getting that difference is the key to making the right call.
So that really gets us to the heart of the matter for this explainer. What is the real difference between them, especially right now? And I say right now because a huge rule change has completely shifted the game, making a ton of the old advice, well, pretty much useless. It's time to get you updated for 2025.
Okay, the absolute simplest way to wrap your head around this is with an analogy. Think of a debt fund like buying a whole basket of groceries, and a corporate bond like buying one single, perfectly chosen ingredient. If you can remember that, everything else we're about to talk about is going to click right into place.
So let's start with that single item. A corporate bond is really straightforward. You are literally lending your money directly to one company. That's it. And in return for that loan, the company promises to pay you regular interest and, of course, give you your original money back when the term is up. It's a one-on-one relationship.
And now, let's talk about the basket. A debt mutual fund takes your money and pools it with thousands of other investors. Then, a professional fund manager takes that giant pile of cash and buys a whole variety of stuff. We're talking government securities, treasury bills, and, yep, a ton of different corporate bonds. What do you get? Instant diversification. So let's just quickly put it all side by side. The trade-off becomes super clear, right? Debt funds give you a pro manager and lots of diversification, but you give up any real control. Corporate bonds, they give you all the control, but all your risk is concentrated in one place. Understanding this is absolutely crucial as we get into the nitty-gritty of risk and returns.
Okay, so let's use our analogy to talk about the one thing that's on every investor's mind, risk. This is where that basket idea really shines. Is your money spread out and safe, or is it all riding on one bet?
And here you can see that trade-off in black and white. With a debt fund, your risk is spread out so thin. If one little bond in that big basket goes belly up, it's cushioned by all the others. No big deal. But with a corporate bond, everything, and I mean everything, depends on that single company making good on its promise to pay you back. We call that credit risk. It's really the difference between having a safety net and walking a tightrope.
All right, let's flip to the other side of the coin, returns. And look, this isn't just about the final number. It's about how you actually get that money and how much work you, the investor, have to put in.
When you invest in a debt fund, you're basically hiring a pro. Their whole job is to manage that basket for you, constantly tweaking things like interest rate risk, all to get you a nice, balanced return. Your performance is just the average of everything inside. So this approach is all about protection and balance, not necessarily chasing the highest possible payout from a single source.
Corporate bonds, on the other hand, are all about precision. You get fixed, predictable interest payments coming directly from the company you picked. And yeah, if you do your homework, and that means really digging into a company's credit rating and their financial health, you can often lock in a higher return than a diversified fund. But it takes more research, and you usually need more money to get started.
All right, now we get to the part that has turned this whole conversation on its head. For years, and I mean years, debt funds had this amazing tax advantage. But as we look at 2025, that advantage has completely vanished, and it levels the playing field in a really big way.
So here is the absolute most important point you need to know. Any money you put into a debt fund after April 1st, 2023 is treated completely differently when it comes to taxes. You know those old rules about long-term capital gains with indexation benefits? Well, for these new investments, they're gone.
And this brings us to the new reality. It used to be that long-term gains from debt funds were taxed at a much lower rate. It was a huge perk. Now, any gains you make are just added directly to your income and taxed at your regular income tax rate. And guess what? That's exactly how corporate bond interest has always been treated. So just like that, the huge tax advantage for debt funds, it's gone.
And when we say taxed at your slab rate, it just means the more you earn, the higher the tax rate on your investment returns. The big takeaway here is that both of these investments are now treated exactly the same by the tax authorities, which brings us to our final question.
So, now that the tax rules are the same for both, How on earth do you choose? Well, here's the thing. There is no single winner. The right answer depends completely on you, your goals, how much risk you're comfortable with, and frankly, how much work you want to do.
So, who is the basket really for? You're probably going to lean this way if you love simplicity and getting diversified from day one. It's for the kind of investor who wants a professional to handle things, who wants that set-it-and-forget-it approach, and who cares more about the safety of the group than the potential home run from a single stock.
And who's the single item investor? This is you if you actually enjoy doing the research, if you like the idea of becoming an expert on a specific company. If you've got a bit more capital to invest, you want total control over your income, and you're okay with that concentrated risk to get a potentially bigger reward, then hunting for that perfect bond might be your game.
At the end of the day, the numbers, the returns, the tax rates, they can only tell you part of the story. They help you build a smart strategy, for sure, but the right choice is always going to be the one that fits your personal financial story and what you're trying to achieve in the long run.
So I'll leave you with this final question to chew on. Now that taxes are off the table as a deciding factor, it all boils down to that one core trade-off. For you and your portfolio, does the built-in safety of that diversified basket outweigh the potential for a higher yield from that one